well, what happened in the Iranian Revolution? Oil production collapsed. What happened when we invaded Iraq? Oil production collapsed. What happened when there was a Syrian civil war? Oil production collapsed. What happened when there was a Libyan civil war? Oil production collapsed. You see where I'm going with this in terms of the potential.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
All right, welcome to another edition of the Daily Dots. This is a special edition. I am joined by the brain trust himself, Mr. Chase Taylor, but I'm also joined by our old friend, Mr. Josh Young of BisonInterest.com. I got into Josh's work because, first of all, there were two things. You put out really good work in the oil space, and that's been really hard to find over the last 10 years. The other thing is any guy that is willing to start an oil-based hedge fund in 2016, 2017, especially named Bison Interests. I mean, talk about pointing your face into the storm. Launching an oil hedge fund since then. Turns out, though, your timing was pretty good. A lot has happened in the world of oil, and a lot is happening now, which is why we wanted to have you on. So, first of all, thanks for joining us, man. I hope all is well in your world.
Yeah. Thanks for having me. Yeah, it was 2015. And
okay.
The thought was that everyone was closing their oil and gas public equity funds. And we looked at what was in these oil and gas ETFs, and it was mostly garbage, even on the large side, but especially on the small side. And the thought was, hey, we can do a lot better. And so we launched in early 2015. We had a bunch of commitments, and of course, no one showed up. It was our money to start, which I think is sort of standard for the buy side. Mm-hmm. And then we went to all the different Ivy League endowments and all the other sort of big endowments and pension funds and said, hey guys, like we can see you have these allocations. Why don't you do this instead? And I have the David Swenson book behind me. Basically the idea is that the allocators, they all decided to just copy him, including himself. He was doing this at the time, to go active, private, high fee, because that was where all the returns were, and passive, public. And they told us they used some like colorful language in terms of how stupid and wrong we were to do what we were doing. And so we like to show the returns, and for this purpose, just to the background, whatever, and we're sort of have the right exemption to be able to share this. So since we launched in May of 2015, through the end of February, we're up about 140, I think it's 141% net. And PSCE, which is the index that sort of best benchmarks versus sort of where we are, the ETF, you can just own it, whatever, is down about 56% net. And then XOP is down 10%, and XLE is up like 20 or 25. This is through the end of February, so before sort of this big move recently. So that's what we do, and the idea is just to try to find cheap stocks with catalysts and to navigate through wild volatility, absorbing some, and try to outperform that's over almost 11 years now.
Yeah, that's especially like you said. I mean, the performance of the indexes versus yours kind of really tells the story there. As a side note, before we get into obviously we've got some big things to discuss, but as a side note, because we're kind of in we're in a very similar business, we manage money, but in terms of our targets that we're looking at, where we're hunting, I think it's pretty similar because we've had crossover in some of the names, and we don't just focus in energy. But what we have come to embrace over time is that what felt like such a headwind for so long, the passive influence, we started to learn to embrace it and realize that it was also delivering us unbelievable opportunities, that we're just going to have to be a little bit more patient. Has that dynamic been true to you? Like, well, while it's made the business side of it more complicated and bringing in more money, we've actually found that we think that dynamic is probably the biggest reason why we found some of the unbelievably cheap opportunities that we have. Has that been the same for you?
Yeah, I think some of it is there's cheaper stocks than there used to be generally, and then dislocations last longer than they used to. And so there's different ways to navigate that. One is just to complain about it, which neither you nor I really do too much, which is good. But I think another way to navigate it is through a combination of being opportunistic. And then what we've done is intermittently gone active with some of these companies where there's been room, whether it's sort of quietly or less quietly, to push them in the right direction to do the things that can allow them to get picked up, let's say by indexes or get bought, or just do sort of the right things that will sort of yield a re-rate. And so, I'd say a good chunk of that outperformance, not all of it, but a good chunk of it was from, I was chairman of a company for 18 months and it way outperformed its peers. Got a lot of hate. I think actually some of like the lunatics on Twitter or whatever that hate me, like it's because of that era, like their parents or their stuff, like stock promoters, all kinds of weird, crazy stuff. But the benefit is that ultimately I'm a fiduciary and my clients significantly benefited financially from that. So, and we did all the right things, I think, from a governance perspective. So yeah, I think I completely agree with that observation. It's a different world than it was when we launched even, a decade ago. And it's a very different world than it was 20 years ago in the public equity space. And I think you have to figure it out one way or another, or you just can't stay in business.
Yeah. All right. So now to the issues at hand, because, anytime you're running a book, there's always boring times and there's always exciting times. When you're running a book like yours that is concentrated right at the fulcrum of this whole issue, if you will, it's got to be pretty saucy time for you. But to start us off on the question side, I got several things I want to get to, but I know Chase has been watching this even closer than I have. So I'll cue it over to Chase. Chase, get us rolling here.
Yeah, obviously the closure of the strait is the big thing right now. And then the most important thing maybe in the whole world for politics, economics, geopolitics is when does that thing reopen again? And obviously the three of us have no clue in reality. But everything's just a probabilities game. What I really want to ask, and is kind of looking at the futures curve, it tells me, like, sure, people are freaking out for now, but no one thinks this lasts, right? What are you finding as far as the way oil and the adjacent equities, not to mention gas, are? How do you think they're discounting when it closes, and what opportunities do you see there?
Yeah, I think people have broadly trusted their political leaders through all of this. And so, I think like since Trump was elected, basically the pushback on owning oil and gas stocks has been, oh, well, Trump said he's going to make oil prices go down. And so people wanted to own oil field services stocks because of drill baby drill, and they didn't want to own oil stocks because they thought that that would happen. They also sort of didn't want to own gas stocks, although then there's this AI boom. So I think that's continued. Again, I think it's just completely led people off sort of on the wrong track. And it's really fun to see the news coverage on it because the reporters can't decide if they hate oil and oil investors more or if they hate Trump and Trump voters more and Trump's policies. So it's super fun. And actually, I've gotten some great intel just by focusing really carefully on what they're showing, and they'll sometimes slip up one direction or the other, and it's just fantastic. So I think it's completely wrong, as I guess the short answer to that, and it's completely, people's understanding of this is completely wrong because they're believing what they're being told without, I think, taking the proper sort of filter on it, which is it's a middle of a war. And, I can both say that like the president and his administration are like lying to us about sort of when this probably ends, just based on past conflicts and sort of the way in which it could end, as well as, observing what happened with the Houthis. And again, no one really knows, but like we sort of have an idea. And I think the other side of it is that we're winning, right? So it's actually not that bad for the US or for Israel. So it's one of those things where I think there's like a European bias to some extent in the media where you have all these people that are like, oh, we're losing, but we're also, going to be fine on oil somehow. And the reality is that like, this is economically devastating for Europe, potentially devastating for China and other parts of Asia. And we're a net energy exporter. Like life is good. Like this is net economically beneficial. Yeah, it's terrible for your Nvidia stock or whatever, right? Which I may have a small left tail position, against as a full disclosure. But I think people are too wrapped up in the stock market as the economy and not sort of focused enough on the economy as the economy, and it's actually fine for the U.S. So again, sort of long answer. I think people are completely misunderstanding it. I think the narrative on it is completely sort of misaligned with the reality, and that's, I think I was trying to explain like why I think that's happening.
Let me jump in there on the pricing dynamics, because this is one of those things that that I learned over time that I did not understand, and I think that there's this, at least for me, there's this tendency, once I learn something or understand something, it kind of becomes part of the common knowledge game, and you just assume that everybody else understands it. Every time one of these situations pops up, I always want to for our listeners, I want to spend some time helping them understand how oil is priced, right? Because there's this opinion of, I just had a conversation with a client. They're like, look, he's like, I think Trump's going to be able to pull it off. I think he's going to get a good portion of that oil through. And I said, well, what's a good portion? And he goes, well, 50, 60%, something like that. And I was trying to explain to him, look, if even 10% of that oil were to be restricted and not move through, it causes massive upheaval in price. So first of all, kind of a two-pronged thing. I wanted kind of give us a primer, if you will, on how oil is priced and how it's the marginal buyer that really sets the price, right? The analogy I gave to the client was, if you sold 100 barrels of oil, it doesn't matter what the first 98 go for. The price is going to be set on the final two, right? And so explaining that, and then also explaining from your perspective, and I realize this is trying to hit a moving target, but with the things that he has suggested, and I know you got connections in the industry and all that kind of stuff, but with what Trump has suggested, saying we'll underwrite the insurance, we'll give them escorts, when you're looking at that in your mental model, what are you modeling getting through? Does he get any through? Is this all bluster just to, back up his stance and keep people from panicking? Can they get some through? How do we look at that? And then, like I said, also two-pronged question, explain how oil is priced so the folks understand.
Sure. And I'll just back up for a second. So I own value equities with Catalyst. So like, I'm not really trading so much around this. So this is fun to talk about. And it is driving performance of the equities that I own and of some of the right and left tail sort of hedges I have on to try to mitigate some of the volatility around this. But I'm not the market neutral, net zero, long short guy or commodities trader that's like trying to get the exact moment on this stuff, which frankly I don't do, not because I couldn't, but I just think it's like a zero or negative sum game where after transaction costs, most people lose at that. So I wanted to caveat that because, like Chase said sort of to the start, like I don't know that anyone really knows. And so, what I'm going to share is my theory and my suppositions and my analysis. But again, I just want to caveat, like, I don't think anyone really knows. And so I'll speak with a certain degree of confidence based on my analysis and stuff. But again, this isn't where like the returns I described, that's not where they come from. And realistically, when you look at almost anyone, their returns don't come from being, they get like sort of directionally correct on this sort of stuff, but mostly it's just from being careful stock pickers and not getting chased out during downturns, not panicking and so on. And just duration, I think, is a way better tool than market timing as a way to compound wealth. So my model for this is what the Houthis did, which is that first the Saudis pounded them with all kinds of Western technology for a long time, and then we pounded them for a long time, and the Red Sea is still partially closed, and they still had sort of mostly a moratorium on attacking LNG tankers and to some extent oil tankers because they couldn't accidentally hit like a Russian tanker or a tanker that was going to bring oil to China. So they really had like a lot of issues in terms of what they could and couldn't hit. The coastline there is a lot smaller. Again, like their ability to manufacture the stuff is way lower. It's only part of the country. They only represent one of the sectarian groups in Yemen. And so Iran is completely different. Like 50% or so of the country hates the totalitarian sort of Islamist dictatorship and wants a new regime. And 50%, and maybe it's off, maybe it's 60% wants that, but 40%, let's say, or 50 want the current folks that are in power, dictatorships stay in power by popular consent to some extent and by force. And so you have a whole bunch of people that want this to keep going. And again, like, it's probably not the majority, maybe it's even 30%, but it's still like tens of millions of people, and they have resources, and they've been planning for this for a very, very long time. In the same way as the Saudis have this pipeline to divert some of their oil across the desert to take it to the Red Sea, which incidentally is going to be interesting to see what the Houthis do about that. But the Iranians have been planning for this for a very long time. And in the same way as the U.S. was building up towards this, and there have been these different exchanges over the last few years, the Iranian regime has been preparing for this. So I think this is very unlikely to resolve in the short term. And I think their ability to destroy tankers, not to beat the U.S. militarily or Israel militarily, but I think their ability to destroy tankers, to destroy other energy infrastructure in the area is not impaired. And we keep seeing that they actually, not only are they able to hit ships as they come by, they hit a ship last night I think it was moored off of Kuwait, and then they hit some Bahrain infrastructure. They hit some in Saudi. They hit the same was it Ras Tanura twice. I might have gotten that name wrong, but a major Saudi refinery twice. So they're showing they can do it, and I just don't know. After seeing the Houthis, I don't know why we wouldn't believe that they can do it. And then the numbers are way too low that people are using. Like, they could potentially, using technology they've already shown us that they have, knock out the Saudi pipeline. The power's already been out in Iraq, so we'll see. And then here, I'll just throw one more thing in there, which no one's talking about, which is driving me crazy. The Middle East is very unstable, and it's run by these like totalitarian religious dictatorships where like this small tiny fraction of 1% of people get all the money and all the power and all this stuff. And these are inherently deeply unstable, and they're backed by the US military, or they're backed by the Russian military, whatever it is. Like, and we've seen how quickly these things can fall, whether it's from foreign intervention or just through sort of domestic unrest, whether it's the Arab Spring or what happened recently in Syria. I think that a number of these Gulf countries are seriously at risk. Again, I'm an oil analyst. I'm not an oil equity analyst. I'm not a geopolitical analyst, but I mean, I've been looking at this stuff my whole life, and I lived in Israel for a year, and I've spent a lot of time abroad and got to know the OPEC guys and stuff. And again, whatever it's worth, I see real instability there. Both in Iran as well as in a number of these different regimes. Iran, actually, weirdly, their regime is more stable in many respects and more broadly sort of supported. I think they're terrible evil, but more supported than a lot of these other regimes. So why does that matter? Well, what happened in the Iranian Revolution? Oil production collapsed. What happened when we invaded Iraq? Oil production collapsed. What happened when there was a Syrian civil war? Oil production collapsed. What happened when there was the Libyan civil war? Oil production collapsed. You see where I'm going with this in terms of the potential.
Well,
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
one of the other things that concerns me, and correct me if I'm wrong, but if you're Iran, it seems to me the very last thing they're going to do is take their finger off the scale in terms of any influence they have over the price of oil. I would assume that's the very last thing that they're going to give up, because that's their greatest source of leverage, is it not?
I mean, it's certainly a great source of leverage. Bombing the towers in Dubai and Bahrain, and it looks like they hit some stuff in Riyadh. That is also a major source of leverage. I have real questions about Dubai as sort of like what I've been pitched it as, sort of a like place for rich people to go and hide and hang out and whatever, non-expropriation, whatever, versus what it's turned out to be. And we'll see how this war sort of progresses and what happens. But I think there's a lot of people that don't live in Israel, for example, because they're worried about the security situation. And it doesn't take much to completely change people's view, which matters a lot because there's a lot of how much value is there in real estate there and various other sort of speculation. And all these companies have invested tremendously in offices there and building the markets. And then there's all kinds of weird stuff that happens in sort of building out markets and various, emerging and frontier markets, all kinds of risks that people and country and companies and so on take in order to do that. There's a lot of money and infrastructure and inertia that direction. But again, one thing I think of, like Bali, for example, where there was one suicide bombing, which was horrible in was it the late 90s, early 2000s, and it knocked it off for a decade, right? There was huge development and then just basically almost a lost decade for Bali because of one single attack. And here you have them hitting over and over again. Why does that matter, right? So that's another sort of leverage point for Iran. But yeah, I agree. I think they understand this. And I think Trump has not done any favors for our European quasi-allies by pointing out that oil matters so much for him and for us. And again, I would argue it's actually higher prices are good for the U.S. economy, not bad. So it actually weirdly, it's like the briar patch, like don't throw me into the briar patch, briar rabbit thing. And it turns out that so the U.S. economy actually sort of weirdly benefits from this to some extent. So what we didn't talk about was setting price, which oil prices are set on the margin. So when we had global oil supply oversupply by a few percent, during COVID, we saw prices go negative, right, which had never happened before. And when we've seen supplies undersupply by even a couple percent, like we saw in 2008, along with some weird stuff in the financial markets, we saw prices go to all-time highs very quickly, way beyond what everyone thought they could or should go to. Similarly, in the 1970s, on an inflation-adjusted basis, we saw crazy high prices, especially around the Iranian Revolution in 1979. So it's a market where there's very little short-term demand destruction. So you end up with prices. I mean, you're seeing this with like Singapore jet fuel or whatever, where it's like $200 a barrel right now. So the refining margins on certain products already are at wild high prices. And those, I think, will actually get resolved to some extent faster. But I think the oil situation and then some of the other commodities and products and so on could get distorted for longer.
It's simple analogy I used, and I'll flip it over to Chase again. Simple analogy I used with my wife and my kids last night was, if you drive somewhere an hour away from home, and while you're at that destination, the price of gas goes up 5x, and the only way you can get home is by filling up your gas and paying the gas price, or are you going to spend the night in your car, or are you going to pay the gas price and go home? You're going to pay the gas price and go home, right? So that's the thing that people need to realize. When you need oil, you need it now. And you become, for the most part, a very price insensitive buyer. So you buy it at your margin sets the price. Chase, take it from there.
Yeah. So you mentioned like the stability of the region. I think that's a very underrated point as well. And one of the reasons is because the Strait doesn't just keep things from getting out; it keeps things from getting in. And I think for anyone out there that's seen pictures of the region, they know it's not exactly Iowa. There's not a lot of farmland. So when I think about like food not coming in and the potential knock-on impacts there, and like you said, some of these regimes aren't exactly stable. But I mean, Bahrain comes to mind because it's a heavy Shia majority run by a Sunni king. Like, I can't think of anything less that's getting bombed and may start getting hungry in a month or two. So that stuff is like, that spread of instability is very concerning. Have you done any work or thought about any of the impacts of stuff that doesn't go in, forgetting the stuff that can't come out?
Yeah, again, I mean, I'm focused on the oil and gas markets. So like in terms of quantifying that, no. In terms of understanding that it's happening, yeah. And that's sort of part of what's going into that analysis. Also, there's local desalination, and then there's also just power issues, and then cross-border flows of energy. So yeah, there's a number of different issues. And then also there's just the very simple reality, which is that Iran has operated terror networks across the West, as well as across other countries that we know of in the Middle East. And so the thought that they aren't doing that also in their neighbors, and there's been some news reports that there were some Iranian terror cells that were arrested. Tucker Carlson, I think, blamed Israel at first, but then it was Qatar put out a correction and said, no, it was Iranian, but they caught a couple, which is very fortunate. But there's huge numbers of foreign workers in these countries. And again, the societal structure is such that for some of the countries, I think it's just purely the foreign workers that are probably the risk. And for some of them, it's a combination of the foreign workers as well as there being sort of this like detached ultra elite fraction of 1% sort, and then everyone else that's mostly like welfare recipients and other folks that are sort of discontent and sort of bribed. But again, the bribe part matters, and then the food part matters, because if you're already sort of unhappy and you see, on social media, you're like princelings out there misbehaving, doing things that they'll cane you for or kill you for locally, but you have access to Instagram, and so you get to see them doing this stuff, right? So you're not happy, and they give you bread, and you have a Camry or whatever, and you sort of like have an apartment, and things are fine. But like the power goes out, and then your food doesn't show up. Then how many days is it before you're in the streets? And there's many people, I think, that were already sort of far more unhappy than those. And again, like I just started talking about this like today. I'm sure that there's people super mad. Like my face is probably like on some like, set of people all fomenting whatever. But I think it's just it's important to understand reality. And just like a few years ago, it made sense to really try to understand OPEC plus spare capacity to better understand the oil market. And it was helpful, but not perfect. And we were directionally right, but not perfectly right. I think this is probably the issue. Like the oil issue matters, but the instability issue, I think, has the bigger risk. And again, historically, we've seen these things go hand in hand, right? We saw the 1973 oil embargo lead to, in some ways, directly the 1979 Iranian Revolution. We saw other sorts of coups and instability in the Middle East around that time too. So I think there's a historical precedent for it too. And I'm probably pushing on it too hard for a, economic discussion of oil. But again, I think this matters so much because people aren't thinking about it. And it's this enormous right tail risk for oil and natural gas and chemicals and fertilizer. And then it's also, potentially and demand for, let's say, defense stocks and other folks, drone companies or whatever. And then left tail risk for markets. A lot of these guys own a lot of stuff in private equity. They own a lot of financial markets. They're just large owners of various stocks and various other exposures. And so I think, and again, there's a lot of exposure. I think like the Fortune 500 companies here in the US have a lot of exposure to Dubai and some other spots. So there's a lot of potential spillover in a lot of different ways from this. And I'm just it's wild to me to see. I mean, no one's really like up till like today, no one was taking the oil's up like, it looks like 8% or so on the day. Everyone was like just pointing to this, and saying, hey, it doesn't really matter so much because look, now 7.5%. And so I feel like in a week when you start seeing protests or riots or whatever, suddenly it'll be all over the news. Everyone will be surprised that there's instability in the Middle East.
Well, that's what we've been focused on. We're looking at the scenario and saying, we don't have a better idea than anybody else how this plays out. But what I can tell you is markets are not responding to it appropriately. Right? Markets are supposed to take every bit of information that is currently available and build that into price. And until today, you just didn't see it happening. And Chase and I have been comparing it a lot to the lead up to COVID. January of 2020 was exactly the same way, where you were watching shutdowns in China, 750 million people effectively on house arrest, and U.S. markets were up 13% in January alone, just completely ignoring it. Discussion for a different day, but I do find it intriguing that at some point over the last 8 to 10 years, the market's response function to crises, to unplanned events, it's become really, for lack of a better term, retarded. It seems like, it doesn't predict or it doesn't price in possibility. It prices in eventuality, right? Like when it arrives, it just drops it on your front door and all of a sudden oil's up, 20% in a day and a half, even though it didn't respond for a week leading into it. It's a strange dynamic. If you have any thoughts on that, feel free to push it in. But like I said, I think it's probably a conversation for another day. But one thought on that, just what it is a lot like is Russia's invasion of Ukraine, where oil went up on that and then faded. And all of these guys, it's the same folks, the same reporters and oil pundits and whatever. They're like, no big deal. Here they sort of like, it was like the economic equivalent of like mansplaining. Oh, here's why it doesn't matter. And like, across every major publication, every fund manager, every sell side, whatever, like, and they put out these like right tail, like, just to cover themselves, we have a scenario, but like, don't worry about it too much. And then of course, when oil went up $40, they say, like that was our scenario. It's like, no, guys, you said there was like a 5% chance of this happening at the time.
So that even more than COVID, I think it reminds me of that. And I traded through that, and it was wild seeing the disconnect between, hey, here's one of the world's biggest oil exporters invading a country that's critical for a lot of, minerals and commodities, and also is very linked to Europe and the US. Like this is pretty similar, I think. So I agree. I think it's a very weird lull. And it is possible the market's right. And again, that's sort of why I wanted to put in that caveat. Like, it is possible oil stocks would go down. They did price in some of it. They had run up way ahead of oil ahead of this. So it is possible the market's right, but this does seem much more similar to those two occasions, the pre-COVID occasion and the Russian invasion of Ukraine occasion. And it's also similar in that we're being told by our politicians, there seems to be like very direct involvement by political leadership in trying to stabilize markets. And historically, the job owning markets can be really effective in the very short term. And then you have this like sort of slingshot effect, which maybe we're seeing today with the oil markets. And then maybe we'll see tomorrow or the day after with oil and gas stocks.
Okay. So this is a messy question, but I'm just trying to, what I'm really trying to do in asking this question is not get a specific, but trying to kind of build out a more complete mental model to try to understand the dynamics here. Because there's obviously so many bloody dynamics. It's a very complex situation. But let's say a percentage, maybe 30%, maybe 50% of oil that typically goes through the Strait of Hormuz. Let's say that that 30 to 50% of that flow is impeded on a longer term. Let's cut, 8 to 12 months, something like that. How long do you think it would take global oil production to be able to ramp up and fill that gap? I have no concept.
That's demand destruction. That's not supply. I mean, we're going to go. So I own some oil rig stocks. So I'll put in a plug just for a second. So I have a fund, but frankly, oil and gas stocks are not very popular. They have not been for a very long time. So I decided that Chase seemed to be having fun with his newsletter and some of my other friends that had newsletters. And so I went, and also I'd been talking about stocks and sort of like specific stocks in different ways, which was not great for compliance. And so I launched a newsletter where I talk about my personal thoughts on individual stocks, and I share like one idea a month. It's called Bison Insights, so it's a plug for it, whatever. And so the idea is just like to just talk about them there, but within that, I've talked about oil rig companies, which could benefit a lot because we could see a number of different companies going and putting on more rigs in that scenario. But there's just not staffing those rigs and then putting them to work and so on. I mean, it'll be amazing. Those stocks will be like 50Xs, especially the ones that have leverage and stuff. I mean, it would be wild if it stayed off. To be clear, like my thought was the situation could continue for, let's say, a month to 3 months. And then maybe there's some instability that, that causes some further right tail event. That was sort of my base model and thus my reaction. But they could all go to work. And the problem is going to be that it's going to take a long time for them to staff up. It's going to take a long time for them to get the right equipment and so on. And then these are the less substantial. There's basically half the rig fleet that's not working right now. And so you're going to get the decremental rig productivity just from an efficiency perspective. You're going to have all of the problems with starting up. You're going to have all of the inefficiencies of a new crew. You're going to have some experienced guys come in, some new guys come in. There's an 18-month ramp up in productivity, even with automation and stuff. Yeah, we saw this during COVID too. That 2020 to 2022, it looked like shale was declining. And I got this wrong with a lot of other people. It wasn't that shale was declining. We were starting to get into a decline, but really what we saw more was that it was just these inefficiencies of scale, where the initial inefficiencies were compounding. So, and then the problem is similar to that era, you start going for your tier 3 and tier 4 stuff, right? Because you have the price signal for it. But a tier 4 well or something might come on with, let's say, 100,000 barrels of oil, and maybe 200,000 barrels of oil and oil equivalent from natural gas and natural gas liquids in the first year, where a core well might have come on with, let's say, 500,000 barrels a day of oil and liquids in the first year. So it's really way, way, way less oil per per new well, and then you have way fewer new wells per rig, and then completions are the same problem, maybe even a bigger problem. And so there is the fleet to do it technically, but it would take forever. And you could maybe get, if you went full speed starting right now, which again, this is part of the policy problem where they should just take it seriously and be honest, and then give it a chance to actually work and for the market to actually respond reasonably. But, maybe you could have maybe an incremental million barrels a day if they went full pedal to the metal today in a year. Maybe it'd be 2 million if you include natural gas liquids here in the US. Maybe you get a few 100,000 barrels a day in Canada, maybe a couple 100,000 barrels a day in, between Australia and Argentina. I think that might be it in terms of swing capacity. So maybe I'm missing a few things.
So, I mean, of course, you're seeing some premium built into oil here, but am I wrong in assuming that what we're seeing in the market with oil at 80, that is the market saying that there's going to be virtually no long-term problems? That this is going to be over really quickly, right? I mean, even at 80, that's what the market's telling us, correct?
That's what the forward curve's telling us. That's what the politicians are telling us. But when you do the analysis, again, it's very similar to Russia's invasion. I mean, this is much more extreme than Russia's invasion of Ukraine, but the market's absorbing it similarly. Frankly, this is much more extreme than anything that we've seen in oil, much more extreme than COVID. Bizarrely, much more extreme than 1973 embargo, because in reality, that only knocked a little oil off the market. It just redirected flows. It was great for the tankers, but oil repriced then because what I described happened, where they brought a bunch more rigs back to work, and everyone was shocked that the incremental wells that were drilled, it wasn't shale, but similar sort of idea, right? You go drill your chalk, you go drill whatever, fringes of fields, halos, whatever. So you have like your reservoir, and then you have stuff that there's like thin reservoir you could hit at the time vertically. And shockingly, those produce a lot less. So they put more rigs on, and actually, I think at that time, there were a few years in the 1970s where they added rigs, but production fell instead of rising. And that's what shocked the market and sent oil up 3 or 4x. And it was pretty sticky. And then it shocked again up another, 2 or 3x in 1979. So this is the sort of recipe. If it lasts a year like you're describing, and it's 50% offline, what you're going to do, what you'll see in that scenario, again, it's a scenario, what you would see is all-time high oil prices, maybe by a lot, and you would push oil into complete demand destruction mode, where everyone's buying an electric vehicle, where you have gas lines, where you have, quotas on flights and various other stuff like that. You have shortages of goods that are truck intensive. You have a whole rationalization of things like you saw in the 1970s because you have prices so high. So that would be, negative for the long-term demand forecast for oil, but I will survive that and sell all my stocks happily at like 50x or whatever, some ludicrously high percentage above where they're at now. And everyone will say it's stupid in the same way as they said a year ago that you're crazy. There's a super glut and you can't own oil. They'll say it's crazy to sell oil and oil stocks at that point, and oil rigs and whatever, and they can have them.
For 50x. For those scoring at home, like the Russia thing took about 1 million barrels offline for Russia, and that took like 2 years to even get the million. This say 50% gets through, and I'll take the under, and anyone wants to take a bet on that, let me know. So it's 50%. You're talking 10 to 13-ish million barrels being offline because of shut-in production and just 10 million not getting through the strait. And that's even if you do go to the East-West pipeline and get some out of the Red Sea. Let's say the Houthis just, lay down their arms and let it all go through or whatever. Like, even in that scenario, you're talking a giant global recession and huge demand destruction. I think Josh perfectly nailed what a lot of that would look like. I have a quick question, Josh. What are your thoughts on refiners? Because we have a good bit of refining capacity in the Middle East that's obviously offline, and just curious on your thoughts there.
I have to do more work on that, but my sense is that generally what we're seeing is more oil coming off than refining capacity coming off. And I think that they'll figure out, again, other than the refineries that are actually being attacked and destroyed, when I look at just sort of the global flows, I mean, I'm getting pitched a lot, the refiners, and you can see the short-term price move, but I feel like that's sort of a head fake. And the reality is that there's much more refining capacity outside of the Gulf than there is oil production capacity outside the Gulf. And I have to go double check and sort of figure out exactly what that looks like. But it's not. I think this move is wrong. I think that the refiners were already sort of in a bull market. People were already really excited about them. A lot of them are already near their all-time highs. Which just generally my approach towards these things. And Zach and I were having a short debate last night on Twitter about this sort of, hey, like for other, commodity producers, my sense is that when things are way below their all-time highs from an equity perspective in commodities, they can be quite interesting. But when they're at or hitting new all-time highs from an equity perspective, commodity producers and processors and stuff tend to be extremely risky and have asymmetric risk reward to the downside. Again, in just my observation of the history of these things, you can make money on them, but it's more like owning sort of like high flying tech stocks than it is owning deep value, discounted investments. So the refiners are more similar to the tech stocks. Again, like much better earnings and so on, but just broadly, and the producers and services companies. So that's my going into my assessment. And then I'd have to go through and redo the numbers, but it looked like on a quick look, it looked like there was more oil that was getting disrupted, at least initially, than refined products. And then some of what's happening is we have these weird dislocations from China, which is sort of the swing refining capacity for the world, where they stopped exports last night, which I think is one of the things that triggered this oil move. They stopped new oil refined product exports, and then they also are ordering more liquefied natural gas, which is very odd. And I think trying to buy more oil too. So I think that's hurting things maybe more from a refining perspective, but I think China's been pretty good on that. They're the world's best oil trader. And so, I think they'll capitalize on higher refining margins, but I just think the numbers are such that you'll end up with a bigger problem, potentially much bigger problem on the oil side, and then maybe some other commodities rather than on the refined product side.
What are your thoughts about, and again, it's kind of one trade, I guess, but how nat gas is more complicated. Where do you see that? What do you see the impacts there?
So U.S. natural gas and Canadian natural gas is landlocked for the most part. And so there have been these sort of theses every once in a while, it's going to converge with Europe or whatever. And eventually, with enough export capacity, that should happen. With enough build out of LNG tankers and enough LNG export capacity, that should happen. And maybe it'll happen by, like, let's say 2035 or something, and depending on sort of the exact scale and speed of these new projects that are, getting built or planned or whatever right now. So we'll see in terms of what happens. But for now, it's its own sort of island, and U.S. LNG was already at maximum capacity on a sort of maintenance adjusted basis. There's always one or two of these LNG facilities. Almost always, it seems that one or two are sort of in maintenance or having some issue or whatever. So there's not 100% utilization, but it's maximum capacity. And similar with Canada, and then they're building more, so it's great there's a long-term play, I think, for U.S. natural gas. But the short term, I'm not sure this helps. If anything, this could actually be quite negative, because if you have more drilling for oil on the back of this, which you will have incrementally more oil drilling, that incremental oil drilling is going to be on lower tier oil resources, which tend to come actually with more gas for the most part. And so not always, but often. And so you're going to end up with incremental associated gas coming from this incremental oil drilling that's likely to happen in sort of a base case here, absent everything getting, obviously all this stuff, like if there's peace tomorrow, which everyone wants, like that would be great, and none of this is relevant. But if there isn't that, and oil prices rise and keep rising, and there's significant disruptions, you have way more rigs running, I think, in the future, and actually way more associated gas getting produced, which would be quite negative actually for the natural gas supply demand dynamic.
Chase, what do you got?
Yeah, first of all, I totally agree with that. But I'll say, going into that too, if we get suddenly just like a boom in NGLs, like I could see that being a situation where the chemical producers get ridiculously cheap feedstock, and then people desperately need their products. You mentioned chemicals and fertilizers and stuff earlier. Do you have any view on, I know it's not, necessarily your lane that you're always in, but on chemicals or fertilizers or anything like that downstream?
Yeah, I actually have some exposure via some right tail calls that I actually put on before this. I added a little bit to this, but they got real expensive real fast. But they looked like they were inflecting. I was actually planning on writing about a basket of these things. Just they look so interesting early this year. And so I have a little exposure. They would be beneficiaries of this. I actually think it's less about having cheaper NGLs, because I think natural gas liquid prices could actually surge on the back of this, depending on exactly what plays out, because there's a lot of natural gas liquids that get exported from the Persian Gulf. And so if those are blocked too, and again, they're going to be deprioritized because they're a lower price than oil. So you're going to have refined products prioritized, and you're going to have crude oil prioritized, and there's some ability to clean out these tankers and sort of shift the use, not perfect, but some ability. And so I think to the extent possible, they're going to sort of shift away from those exports because they're relatively lower value. And so that could actually materially benefit the realized price for natural gas liquids, maybe way in excess of the incremental supply from the US in a sort of drilling boom scenario. I'm not sure exactly, but I think the chemicals would work anyway, because the lower natural gas price, I think, matters more than the lower NGL price for a bunch of them. They're very gas intensive as an input, and then some of the, from an energy perspective, and then some of them use gas, or, maybe like an ethane or something like that might still be very cheap, especially from a global perspective. But I think they're just going to have a relatively cheaper feedstock. So I think they should do well from this, but I'm not sure I buy the NGL collapse on this. I think the natural gas will be quite weak, potentially to the extent that we see a bunch more drilling activity, but I'm not sure about I think it really depends. And I frankly have to do more work on that to figure out exactly my view.
Okay. So switching over to the investment side, I think we've covered the oil side of it, and that's pretty obvious. And that's owning some oil. Oil moves up one way or the other. Make money doing that. That's obvious. Owning some of the producers. When you're looking at the landscape today, and again, you've already got positions on, and you're ready to rock and roll. What do you think if you had money to put to work today in energy, in and around energy? Where do you think the most convex areas are that people are not paying attention to right now? Or is it just obvious? Is it just own the producers, own some right tail kind of calls on oil maybe? Or is there a little sector of it that you think is really juicy that maybe most are missing?
I really like the U.S. land rigs here. I think the equities are really mispriced. The utilization's low, but the pricing power has remained. There's this very weird situation where, again, I have the most exposure I've ever had in my career to U.S. land rigs and Canadian land rigs to a lesser extent. But normally in a downturn for a cyclical, you can either buy them at a big discount to replacement cost or at a big free cash flow yield. And these things have been so abandoned, but there's also been so much consolidation in the sector that they've been able to maintain pricing power to some extent, even as the rig count has collapsed. And so you have these companies with decent, it's not great pricing power, but they're earning real money. The equities have imploded. So they trade at nice free cash flow yields because the stocks are so low, not all of them, but many of them. And so you get this nice free cash flow yield, which you really shouldn't be able to get at the bottom of a cycle, along with a fifth or a sixth or something of replacement cost. And you get told all the time, oh, these things are going away, no one's ever going to use them again, which is like absolute music to your ears, I think, as a deep value investor and a cyclical investor. It's the thing you want to hear is, okay, cool, you guys all destroy your rigs, and I'll go buy the guy at 50% utilization at a 20% free cash flow yield, a 15% free cash flow yield, with a whole bunch of, they're sitting on a whole bunch of unutilized rigs. So yeah,
Josh, we have a way of looking at the firm. What you just described to us is that's the last bus stop before investors acknowledging, well, sure, the profits are going to go way up, but the equities aren't going to follow suit, right? Like I feel like those are the last two bastions. When you start hearing those arguments, that's where you're like, okay, we're all clear to go in there and start buying with both hands.
Yeah, I mean, I wrote about a land rig company very recently, and there's literally only one analyst, one sell side analyst that covers it. And he called me up and he said, "Hey, Josh, I think your numbers are off." And he used the numbers adjusted from the stock. It went up after I wrote about it. And so he used the numbers from the higher stock price. He's like, "Hey, the free cash flow yield is like 13%." And, I had said 15%. Well, when it goes up 20%, then, of course, you're going to have that adjustment but that's fine. But like, otherwise, like, yeah, I completely agree with it. Like, these things are just ridiculous. This one is like smaller, so maybe it'll get less attention. And it was a full turn cheaper than all of its comps just because it was smaller. And he said he couldn't show it to clients of his firm because no one wanted to see a company of that size, of this type. They didn't even want to see the companies that were 10 times bigger of this type. And so, yeah, it's basically like one of the last stops.
So do you think with those land rig companies, am I hearing you correctly where it sounds like you like them as a long regardless of the current situation that's playing out? Is that fair to say?
Yeah, I think like the general trend has been declining per foot well productivity in shale as shale has matured. And I was on with you guys a few years ago saying, "Hey, I think shale is gone and we're going to see declines." And I was wrong. And again, the specific thing that I messed up on that was I extrapolated the disefficiencies essentially from bringing on additional rigs and the problems when they put those new rigs essentially or reactivated rigs onto tier 3 or tier 4 locations onto sort of the whole. I think I used aggregated numbers that were not indicative of sort of the full potential productivity. I think we have a much, much better look at what the full potential productivity is at this point after having many years of additional activity and additional completions and so on, as well as getting to see the financial impact for the upstream companies as they've engaged in this drilling activity and consolidation and now allowing decline in a number of their different fields while sort of barely keeping production flat and just going into decline. There's the EIA showed declines for, I think it's the last 3 months in U.S. oil production, higher NGLs, lower crude, and it looks like the aggregate should be, absent any sort of rig jump now, should be going into decline here. So I got it wrong, which is important, I think, to understand. When you're wrong on something, you really want to understand what the analytical process was that was wrong, and then what is different this time, if anything. And I think that's sort of the change. And so I think you're going to need a lot more rigs I think the oil price was too low coming into this, as evidenced by the poor financial results of the companies that were trying to keep these rigs active. And so I think you needed higher oil prices to keep rigs active, and then even higher prices to bring more rigs on. And you needed more rigs on because the companies couldn't sustain their production levels at the level of activity they were at. And you couldn't sustain that level of activity even at those current prices. So there was this pressure down on activity because the prices were too low, and there was a delay on the pressure on production. And everyone's models had the production growing. And so without that growing production, you were going to have higher prices anyway. And you sort of had this bleed up on the back of this super glut thesis breaking, where there was supposed to be 4 million barrels a day of excess supply Q1 of this year. And again, that's where I was alluding to the journalists. So like Bloomberg accidentally showed everyone that in January and February, we had inventory declines. They were trying to show how there was all this extra sanctioned oil that was on the water that could get dumped onto the market. And accidentally, by trying to highlight that, they showed what the total oil was, and that total oil had come into decline. And it's like, "Hey, this is beautiful, guys. Thank you." And they show all their different sources there. And then Goldman copied them as sort of showed their own charts with like 5 more sources of data. And so I can say with some degree of confidence that oil was actually in decline in January and February, when we were supposed to be a 4 million barrel a day surplus. And there were reasons. There was some oil offline from Venezuela, some from Kazakhstan, whatever, but not 4 million barrels a day offline. So anyway, I think we were in this setup where these things should have been working anyway, and people were reaching that max hate. And so it's just such a beautiful setup. Max hate, stocks were starting to bleed up anyway a little bit, finishing paying off debt, starting to buy back stock. Just so beautiful as a value investor owning these things at these giant discounts, and they're sort of infrastructure, right? Like the problem is the cash flows sort of fluctuate, but the long-term value of the investments that were made by these companies years ago is preserved. And so you have somewhat sort of volatile cash flow, but sustained. Like your cash flow is hard to predict from the stuff any given year, but your decade of cash flow from this infrastructure that you've built essentially is somewhat certain. And your 2-decade cash flow is very certain, and you just have to not measure it at the top or the bottom. And so, these things are very, very beautiful. So long way of saying, yeah, like they're just so great coming into this. And then here you have this tailwind, and they're not really moving much. They're not, no one's hired a rig in the last week or so that I'm aware of, or at least not many. And I think like everyone's in shock. All the E&P companies are sort of hiding other than their conference calls. And there's been a few news articles like FT ran it, like Shale isn't going to bail Trump out or whatever. Again, like these weird sort of like combinations of like disliking the industry, but disliking Trump and deciding which they dislike more. So anyway, really good setup, I think, for these independent of this particular situation.
No, that's great. Chase, do you have anything? I've got one final wrap-up question, but do you have anything else that you wanted to ask him?
No, but I have one final comment, and that is the highlight of this for me, and I think an awesome takeaway for everyone. Obviously, all this energy talk was great, but the fact that Josh highlighted something like an analytical error, the fact that he dove into it, figured it out, and now is fixing that like as a tool to make like even better decisions, like that's what investing is all about to me. Is I think that's awesome.
I'm glad you brought that up, because that's one of the reasons we called Josh. When, and I'm not sitting here trying to pump sunshine up your skirt and make you uncomfortable, but one of the reasons we call Josh is because Josh has been frustrated by the same thing we are, which our industry, for whatever reason, is like a hotel for charlatans. Everybody wants to get up and say what they think. Nobody wants to actually go do the work. And then, Josh started this off by talking about what he got wrong. And the reason I like that is not because I hate it. The reason I like that is because when you become an investor and you really dedicate your career to trying to get it right, you realize that that's the path forward. The low hanging fruit is the mistakes you made. And when you hear somebody not talk like that, it makes me really question the veracity of their ability, the returns they produce, and their level of professionalism in this business. Because, as professional investors, we're running toward the mistakes. It's where'd we get it wrong? That's where you want to learn. So it's why we reach out to Josh, man. It's also why I would advise everybody to subscribe to the newsletter. I can't believe we haven't. I'm going to make sure that we do that. So in closing, Josh, I'm going to ask you the most unfair question in this, because like I said, it's a completely moving target. And so to make it a little more fair, I'll throw mine out. Client asked me this morning, Zach, how do you see this thing playing out as it relates to markets and it relates to oil? And I said, listen, I know barely enough to be dangerous about this whole thing and understand all the ins and outs. I know a lot more today after discussing with you. But I said, look, if you were going to look at me to handicap this, I will be surprised if we get through this without seeing oil at least pop above 100 at some point. I could be way wrong. I think that this will last longer than is currently being projected. I also would be surprised if it was something that we're dealing with years from now, although with our recent excursions into the Middle East, I don't think you can completely remove that off the pool of possibilities. But let me throw it to you. That's my rough, uneducated, I guess, take on the situation. If I was to throw the same thing at you, realizing that things are going to change, situations on the ground will be different a week from now. We don't know what they're going to be. But sitting back today, how are you conceptualizing it in your mind, right? We all have our own mental models we're looking at, levels that we're watching. How do you think this plays out as it relates to the price of oil?
So I always start with this just from like a risk perspective. I always worry about what happens if things go against me from a positioning perspective. So my concern is again, it would be great for the world, but for my portfolio, it would be devastating if there's, the Ayatollahs capitulate tomorrow and, whatever, like there's some sort of democratic republic that gets established in in Iran and they stop firing at the tankers and the flows start again and everything's good and all these things that shut down turn back on and life is good. That would be, I mean, there would still be some disruption, but it would be very addressable. And frankly, with extra production from Saudi and so on, like the oil market would probably fall a lot, energy stocks would fall a lot. That seems extremely unlikely to me. And my base case is based on what we saw happen with the Houthis, like I described, where I think that unfortunately we're going to see tankers get hit. We're going to see more tankers get hit. They've already seen some. And I think that the more successful the US and Israel are militarily in attacking the Iranian regime and in moving towards regime change and in reducing the nuclear and missile threat that Iran posed, the more successful we are, the more they're going to attack energy infrastructure. I think it's just a reality. And so I think we are going to end up seeing, I think we see higher than $100 oil as my base case. Again, I'm worried about the downside. I'm trying to position so it's not catastrophic in the downside. And at the same time, I think there's a decent chance that we see much higher than $100 oil. $100 oil is like $70 or $65 oil pre-inflation, pre-COVID. So I think we see much higher oil. And I think it might not take that long. It might be a question of days in terms of low flows from the Strait of Hormuz, along with additional sort of panic from various governments as you see China go and bid up oil and LNG, as you see sort of various other responses. And so, I see potentially much higher oil prices. I see way higher valuations in oil and gas stocks. And we're starting to see, we saw the big ones move ahead of this, like the Exxons, Chevrons, whatever. And we're starting to see like the meme stocks, like microcap, whatever, things go nuts right now, which is also actually a pretty good sign that things are starting to go crazy. That happened in 2008. There were a number of companies that went up 10x, 20x or whatever before everything crashed. And they didn't just go up 50 or 100%. So we're starting to see some of the nonsense, the California offshore nonsense, or, you know, West Texas insolvent company, but trading up or whatever. So we're starting to see stuff like that. And so that makes me think that there's the markets, like the oil market's been shrugging it off until today, but I'm starting to see indications of edges of the market starting to panic. And then this could all lead to potentially much lower equity prices, particularly companies that are credit sensitive and, and also to companies that are trading at really, really high valuations.
Hey, Josh, I can't thank you enough for doing this, man, especially doing it on short notice. I know our listeners are grateful as well. Give us the full rundown. So where people can go to follow your work, Twitter handle, where they can go to sign up for the newsletter. Hit us with the whole deal.
Sure. Okay. So I run an investment firm, Bison Interests. You can find more about it at bisoninterests.com. I run a newsletter. Like I said, it's my personal just opinions about stocks and the oil market and so on. I share a stock idea a month. It's on bisoninsights.info. They're completely separate. I disclose all conflicts and all ownership and everything on the newsletter, and all my fund clients and investment firm clients are aware of the newsletter and have access to it and so on. So it's all sort of above board and, you know, people are aware of it. And the newsletter has been sort of wildly successful, which is pretty fun. I have over 1,000 paid subscribers in addition to the clients that I gave access to, and it's been growing very quickly. And the stock picks for most of the newsletters that I've seen, financial newsletters that talk about stocks, they tend to have sort of fluffy reporting on sort of the performance. And I run an investment firm, so I have been trained and beaten into submission to show really accurate numbers. So I just literally just track every single stock or related security idea and the price the day before it was talked about, and then and even comp it versus, I've been using the XOP ETF as the comp, just because, you know, some of these things are bigger or smaller or whatever, but XOP is at a size that people, I think, seriously consider investing in. And so it feels appropriate to show. So anyway, that's bisoninsights.info. And again, it's very weird. Like, social media makes it very hard actually to promote these things. They've been blocking links and stuff. So people are still finding out this thing exists. I'm 11 ideas in, and I think 10 out of 11 have outperformed XOP since I've shared them. And 3 of them have outperformed by more than they're, let's say XOP's up 20 or 25%, they're up at least 70 or 75%. And a couple have been more than 100%. So that's been pretty fun to have that over the last 8 months.
No, man, that's awesome. And I'll tell you, I don't know if they've ever become clients, but Josh is the only person. Maybe I've directed people toward Cuppy before, but outside of us,
Cuppy as well.
Yeah, where I've actually sent people to them and said, look, if you're going to start an energy only portfolio, that's who I'd go to. So as another guy that gets paid to manage money, I don't really think you can endorse somebody more than that, where you look at them and go, hey, if you want an energy only portfolio, not a bad idea, but I don't think we're the best place to get it. So can't really say much more about you than that, man. I really appreciate you coming on. Thank you for your time. God bless. And I guess we'll see how this thing plays out, huh?
Thanks for having me. I really appreciate it. Nice to see you guys.
You bet, guys. Thank you so much for joining us as well. This will be released today. Well, you're listening to it now, so you know that. And we'll also do our normal Daily Dots edition. So until the Daily Dots, we'll see you then. You're listening to the Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC-registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.